Good morning to everyone. Good morning. Good morning. Now, already morning discussed part. Now, remaining part we are going to discuss. Okay, friend? Okay, Sreeman? Okay. Let's start. After this half an hour, I'll go to shop and bring water and restart. Now the part will be complete and will go. That's what I want to complete this. Then go best. Let's start. My friend Sreemannarayana. My dear friend Sreemannarayana. Yes, listen. Dear Sreeman, remember what I am speaking. The free float market capitalization. I already spoke to you, Sreeman. Dear Advocate Sreemannarayana Mallela, my dear Advocate Sreemannarayana Mallela, what I am telling to you, the free float market capitalization is equal to overall market capitalization into percentage shareholding by non-promoters. The concept of the free float market capitalization is a free float market capitalization is equal overall market capitalization into percentage of shareholding by a non-promoters. Understand, my dear friend Sreeman? My dear friend, People's Advocate Sreemannarayana Mallela, you kindly listen this. Impact of the business, impact of bonus pledge. My dear friend Advocate Sreemannarayana Mallela, increase number of shares and EPS, MPS, BVPS will go down. Overall market capitalization will remain the same. Impact of revision in growth rate of firm. Value of the target company business will increase in case growth rate increases. Compute existing cost of capital as overall dividends divided by existing value plus growth. Compute revised value of business as overall dividends divided by existing KO minus new growth. The impact of the revision in growth firm, impact of the revision growth rate of the firm is equal value of the target company business will increase in case of a growth rate increase. Compute the existing cost of capital is as overall dividend divided by existing value plus growth. Compute revised value of the business as overall dividend divided by existing KO minus new growth. Dear friend, my dear friend, advocate Sreemannarayana Mallela, I am telling to you, my heart telling to you, my dear friend, okay, my dear friend Sreemannarayana, price earning per share, PE multiple, EPS, ROE or BVPS. ROE, BVPS will impact the price price EPS into PE multiple. See, the components of the price is one is EPS, another one is ROE into BVPS or EPS into PE multiple. So ROE, BVPS and PE are the components of the price. My dear friend Sreemannarayana Mallela, listen. How final exchange ratio decided in negotiation. Intrinsic value is equal real value of the company taken as equal to market price in absence of the information. Intrinsic value is the real value of company taken as equal to market price in absence of information. Intrinsic value, exchange ratio based on adverse parameters. Adverse parameters are those with an organization wants to minimize, such as NPA, expenses ratio, cost of goods sold ratio. We should take exchange rate as equal to the base value, and notwithstanding should be done all these cases. The ratio related to bank merger, GNPA percentage is equal GNPA rupees divided by advances into 100. Whereas a car percentage is equal net worth divided by risk weighted assets into 100. Okay, my dear friend. Sriman, okay. Understand, Sriman? Are you understanding? It's going into your brain? Okay, Sriman. Thank you. Thank you, Sriman. The post-merger profit after tax of the next year, the normal approach, profit after tax and acquisition cost of year 0% plus profit after tax of target company of year 0 into 1 plus post-merger growth of the merged firm plus synergy gain. My dear friend, people's advocate Sreemannarayana Mallela, kindly listen. Profit after tax of acquisition of year 0 plus profit after tax of the target company year 0 plus into 1 plus post-merger growth of merged firm plus synergy gain. Retained earnings are already reinvested. Profit after tax of acquisition of the year 0 plus acquisition growth rate plus profit after tax of the target company of the year 0 plus target company growth rate plus synergy gain. So the post-merger profit after tax of year 2 is equal post-merger profit after tax year 1 into 1 plus merged company of the growth rate. The post-merger profit after tax, if retained earnings have already been reinvested, then post-merger profit after tax of the next year, normal approach is a profit after tax of the acquisition company, year 0 plus profit after tax of the target company, year 0 into 1 plus post-merger growth of the merged firm plus synergy gain. Post-merger profit after tax year 2 is equal post-merger profit after tax year 1. Post-merger profit after tax year 2 is equal post-merger profit after tax year 1 into 1 plus merged company growth rate. The bonus issue to reduce the promoter holding. Promoter, a shareholding is reduced to comply with the SEBI norms, and this is done by giving a free share only to minority shareholders. Post bonus number of shares held by a promoters divided by desired promoters shareholding percentage. Desired promoters shareholding percentage. Number of bonus shares allotted is equal to post bonus number of shares minus existing shares. Number of shares allotted is equal post bonus number of shares minus existing shares. Bonus ratio is equal new shares allotted to minority existing shares held by a minority. Post bonus number of shares is equal shares held by a promoters divided by desired promoters shareholding percentage. Number of bonus shares allotted is equal post bonus number of shares minus existing shares. Bonus ratio is equal new shares allotted to minority existing shares held by a minority. The funds available for merger. Post merger shareholding, existing shares in acquisition company plus existing shares in target company into exchange ratio divided by post minus merger overall shares. Existing shares in acquisition company plus existing shares in target company into exchange rate. Existing shares in acquisition company plus existing shares in target company into exchange ratio divided by post merger overall shares. First, fund available for merger. The maximum debt post merger net worth, debt divided by equity is equal the maximum new debt is equal total debt minus existing debt of the acquisition company and target company. Available cash and securities, available cash and cash equivalents, and for total fund maximum new debt plus cash and cash equivalents. These are the funds available for merger in case cash consideration. The post merger shareholding of a shareholding who has shares both acquisition company and target company. Distribution of shares to a target company shareholder in case of partly paid shares. Convert partly paid shares into equivalent fully paid shares. Exchange ratio is equal to shares allotted total fully paid shares. Allot shares based on this fully paid and partly paid shareholding. This is the distribution of shares in case of partly paid shares. How? Convert partly paid shares into fully paid shares, and exchange ratio is equal shares allotted to total fully paid shares. Allot shares based on this to fully paid and partly paid shareholders. This is the distribution of partly paid shares concept. Next, my dear friend, People's Advocate Sreemannarayana Mallela, kindly listen what I want to tell you. The valuation of debt and equity, a not logical item. Valuation of debt and equity of the merged firm. Value of debt of the merged firm is called value of debt of acquisition company, value of debt of the target company. Individual debt values is weighted average of various values at different scenarios. My dear friend, People's Advocate Sreemannarayana Mallela, are you understood, my dear advocate? My friend, Advocate Sreemannarayana Mallela, listen. Value of equity merged firm is equal to value of equity of the acquisition company plus value of equity of the target company. My dear friend Sreemannarayana, please listen. What I'm telling to you, please listen, my dear friend Sreemannarayana. Value of equity merged firm is equal to value of equity of the acquisition company plus value of equity of target company. Individual equity values is weighted average of various values at a differential scenario. Differential scenario. Concept number 32. The valuation of debt and equity. Return on equity is equal earnings available to equity shareholders or profit after tax divided by amount of equity is equal to value of debt and equity. My dear friend, Sreemannarayana, return on equity is equal net profit margin into asset turnover into equity multiplier. Net profit margin is equal to profit after tax divided by sales. Asset to turnover ratio, sales divided by assets. Equity multiplier, assets divided by equity. My dear friend, let's go going forward. Assets is equal debt plus equity if no information is given. Business valuation chapter, internal reconciliation. Internal reconstruction, compute capital reserve. Prepare revised balance sheet post reconstruction giving effect to changes. CR is equal items increasing, NW is equal items decreasing of the network. My dear friend Sreeman, please listen. What I want to tell you, my dear friend Sreeman, internal reconstruction, compute capital reserve, the capital reserve items increasing, net worth minus items decreasing, net worth minus item decreasing net worth. Concept number 19. Business valuation of chapter internal reconstruction. Minimum consideration for promoters. Promoter can enjoy allied benefits such as higher remuneration due to majority shareholding. Hence, they need to be compensated for the same. My dear friend, understand it? Yes, you will understand. The minimum consideration for promoters can enjoy allied benefit such as higher remuneration due to majority shareholding. Hence, they need to be compensated for the same. The minimum consideration for promoter can enjoy allied benefits such as a higher remuneration due to majority shareholding. Hence, they need to be compensated for the same. Minimum price is equal existing market price share plus value of allotted benefits divided by number of shares held by a promoter. My dear friend, my dear friend, the mergers and acquisition is completed the concepts. Tomorrow we are going to solve problems and solutions of mergers and acquisition. Now I am going outside to bring water bottle. After I came maybe 6 o'clock, I would like to start till 7 p.m. is another chapter, concepts alone discussion, formulas discussion, concept discussion, important theory discussion. All this we do. Later on, we'll be stepping to the question papers one by one. We do question papers. Guys, thank you who watched this YouTube channel. Thanks to everyone. I would like to grateful to you. Thank you very much. Bye bye. See you. Tata.